Okay, we are at our review session for this week, and the first thing that we're looking at is exercise 5 from chapter 22. This is the one in class this week that we did not complete together, but you were asked to work on independently. So we're looking at a production budget, and the format for the production budget would be our single point estimate of how much we expect to produce would be start with, well, how much do we expect to sell? But we don't have to, that's not the whole picture if there's any change in our inventory level. And so we add to that our desired ending inventory to find out how many units, in this case, how many pairs of pants we need to have available throughout the month. And then we subtract from that our ending inventory. And this exercise does tell us specifically to use the minus sign when we need to subtract. So sometimes the software lets us get away with not using minus signs, but in this case, it does specifically tell us we need to do that. And so here we have our production budget. And as we discussed in class, so everything starts with the sales. And from the sales, as we did here, we can calculate how many we need to produce to support that level of sales, plus any desired change in our ending inventory. From that, once we know how many units we need to produce, and you'll notice there are no dollars involved in the production budget. There would be dollars involved in the sales budget because our sales are dependent in part on how much we're charging our customers. And so it is critical for our whole budget process that we have a dollar amount for those sales as well as a number of units. But once we know how many units we need to produce, we can go ahead to prepare the next parts of the operating budget, which are the direct materials, direct labor, and factory overhead. So what we have for the last part of this exercise is the direct labor budget. And we are given right here how much direct labor is required for 10 pairs of pants. And so as we look at our production numbers, we're mathematically, you can do either one of these things. You can divide that production number by 10, and then to find out how many 10 unit or 10 pair units we're producing, or you could divide each one of these number of minutes by 10 to find out how many minutes one pair would take. Mathematically, you're doing the same thing. You can think about it whichever way is easier for you. To me, it's easier to take this units produced and divide by 10. And so for Dockers, for example, we're going to produce 2,335 10 pair units. And then we can simply take that number and multiply by each one of the direct labor sources here. There's 4 separate sewing operations that need to be performed. If each one of those had a separate price, it would be critical that we keep it separate. If each one of these is performed by the same individual, and so the cost per hour would be the same, then we could just use, in a simpler version, we could just use this 56 minutes. Our budget is for each one of those operations separately. And it does tell us that there are different wages for at least 2 of those, 2 different wages for the 4 different operations. So let's start with our Dockers. And I think if we do the Dockers together, then I can ask you to complete the 501 part on your own and see if you have any questions about that. I want to make sure we're using our time efficiently. So for the Dockers, it's going to take 18 minutes for the inseam. And so keep in mind that our costs are per hour. And what we're calculating here is the total minutes, and then we'll change or convert that total minutes into total hours so that we're using the same units for our cost. So for the inseam for Dockers, 42,030 minutes. That's the 2,335 10 pair units times 18 minutes per unit. And I've had a change of mind. Let's go to the, let's do the inseam part for 501 so we can complete that column. So we're going to produce 53,300 total pairs. So that would be 5,330 units of 10 times the 9 minutes per unit of 10. And so for 501 jeans, we would need 47,970 minutes of inseam time. Total of 90,000 minutes of inseam time. How many minutes per hour? 60. And so if we divide that by 60, we will get our total number of direct labor hours for the inseam operation. And we are told that the direct labor cost for inseam is $13 per hour. Okay. So in the interest of time, wanting to make sure we maximize our use of this hour that we have, does that make sense? Do you have any questions about that, or do you feel comfortable that you can move ahead with the other 3 operations and complete this budget? Feel comfortable with that?
Yeah, I just yeah, I didn't know I didn't know I had to divide the total units to be produced by 10. I just didn't know
Oh,
that.
yeah. And that's something that's easy to overlook because it does say it here, but it's kind of hidden there. So, yeah, we've seen that before in this software. Most every word they write there is something that's critical for understanding the exercises or problems. So we tend to skim. I do the same thing myself. Okay.
I'm
All
good
right,
on this one. This is what I was finishing on Excel yesterday at the end of class.
Oh, sure. Okay, let me pause here for a moment. Okay, so we're shifting from exercise 5 from chapter 22 back to the chapter 21 problem. So in this problem, there's some multiple choice, which of these applies to variable versus absorption costing. So you should be able to do those on your own or even look up those answers in the textbook because those are fairly straightforward based on what we've already discussed. We're then given an absorption costing income statement. We know that in the absorption costing income statement, the difference from a variable costing income statement is how the fixed manufacturing costs are treated. Absorption costing is what's required for GAAP, and those fixed costs are going to be included in the cost of goods manufactured and in ending inventory. So they some go on the income statement as part of cost of goods sold, but others are going to be attached to units in ending inventory. On our variable costing income statement, so same company, same information, but packaged together differently, what you see is different is that the fixed manufacturing costs are all expensed in the month in which they're incurred, rather than splitting them between cost of goods sold and ending inventory. So what we are asked to do here is compare the results between those two financial statements, absorption and variable costing for the same company in the same period. Review the income statements, complete the following table. The company's sales price per unit is $75 and the number of units in ending inventory is 5,000. There was no beginning inventory. And so they give us that simplifying assumption, not typically going to be true, of course, but it is important for us so that we don't need to know, for example, do they use LIFO or FIFO? What happened to those beginning inventory units? We don't have to worry about that since we're told there is no beginning inventory. So number of units sold. Well, you'll notice that the sales on both are the same. $1,125,000. And we are told that the selling price is $75. So how would we determine the number of units sold?
When we
Go ahead.
divide 75 by 1.
Yep,
Okay.
you said it in reverse, but I think you know what you meant to say, which is we take the sales and divide that by the selling price per unit. So if we take that sales, 1,125,000 divide by $75, we learn that they sold 15,000 units. And so if the ending inventory is 5,000 and they sold 15,000 and they didn't start with any units, how many units did they produce? Let me skip down here. How many units did they produce? They didn't have any at the beginning of the year. They didn't have any at the beginning of the year. They sold 15,000 and had 5,000 left. So they must have made 20,000, right? They made 20,000, they sold 15 and had 5 left. The next question is our variable sales and administrative costs per unit. And so here we have our selling and here on the absorption costing, our selling and administrative expenses are the period expenses, and they are all lumped together regardless of whether they are fixed or variable. But here under variable costing, we subtract all of the variable costs to find our contribution margin. And so it was necessary that we separate out the variable from the fixed. So our variable selling and administrative expenses were 195,000. And how many units did we sell? So 195,000 divided by the 15,000 units that we sold. And that would be $13 per unit. All right. Next, we have our variable cost of goods manufactured per unit. So here's our variable cost of goods manufactured. That is for all 20,000 units that we produced. So 600,000 divided by 20,000. Our variable cost of goods manufactured is $30 per unit. And our fixed manufacturing costs of 240,000, again, that's for all 20,000 units that we produced. So $240,000 divided by 20,000 units is a fixed manufacturing cost of $12 per unit. Are we good so far?
Yeah.
Okay. So let's see what else we need to answer here. Whenever the units manufactured differed from the units sold, finished goods inventory is affected. In analyzing operating income, such increases and decreases could be misinterpreted as operating efficiencies or inefficiencies. Each decision-making situation should be carefully analyzed in deciding whether absorption or variable costing reporting would be more useful. But remember, absorption costing is required for external reporting under GAAP. All costs are controllable in the long run by someone within a business. For a given level of management, costs may be controllable or non-controllable. The production manager for Saxon is worried because the company is not showing a high enough profit. Looking at the income statements on the absorption statement and the variable statement, he noticed that the operating income is higher on the absorption cost income statement. Well, why is that? Because they produced for inventory. And so by producing for inventory using absorption costing, that allows them to shift some of those fixed manufacturing costs onto the balance sheet as an asset rather than expensing them in the year in which they're incurred. He's considering manufacturing another 10,000 units up to the company's capacity for manufacturing. So remember, we've talked about the 3 different types of capacity: theoretical, which is not very useful for decision-making purposes; practical, which is what they're talking about here, how much can they produce in the real world; and then there's their normal capacity, which is how much they expect to produce. So the production manager reasons that by producing an extra 10,000 units, it will boost operating income and satisfy the company's owner that the company is sufficiently profitable. Although the total units manufactured changes, assume that total fixed cost, unit variable cost, unit sales price, and the sales level are the same. So remember, we sold 15,000 this year. He's talking about, and we produced 20,000. So he's talking about next year producing another 10,000, so a total of 30,000 units, even though he expects to only sell 15,000. We've talked about the concept of pull-through production, how that's really not a good management decision. But I agree that on the income statement, it will look good because they'll be able to shift even more of those fixed costs onto the balance sheet as an asset. So we are asked here to use the income statements on the absorption and variable statement to complete the following table for the original production level. Then prepare similar income statements at a production level 10,000 units higher and add that information to the table. Assume that total fixed cost unit, variable cost unit, selling price, and sales level are the same at both production levels. Okay. So this is operating income under the original. So we're just going back to our 2 financial statements we already have. Under absorption costing, the original operating income was 235,000. And under variable costing, that number was 175,000. Under variable costing, keep in mind what we are looking at. So the only thing that goes on to the income, excuse me, the only thing that goes on to the balance sheet under variable costing is the ending inventory's variable costs. So, excuse me, per unit, those variable costs are not going to change. What's going to go on the income statement is all of our fixed costs and the variable costs for the units that were sold, and those units aren't going to change, right? Give me 1 second here. And so the income statement for under variable costing is mostly unchanged because the ending inventory is going to include, so the variable cost manufactured will go up, but the ending inventory will go up in the same ratio. The total variable cost of goods sold is going to be exactly the same because we sell exactly the same units. So these 2 numbers, variable cost of goods manufactured and ending inventory, are both going to go up by the same amount. Everything else on here is going to remain unchanged. And so the operating income under variable costing will be exactly the same whether we produce an additional 10,000 units or do not produce them. Does that make sense? Okay.
Yeah, I think so.
Okay. So what we're going to do next, though, is look at the absorption costing, and I'm going to put our additional numbers in here just next to this. And let me remind myself of what those numbers are. So we have $30 in variable cost of goods manufactured, 12 in fixed manufacturing, and when we produce 20,000 units, and variable sales and administrative of $13 per unit. Okay, so our cost of goods manufactured, if we produce 30,000 units, our cost of goods manufactured will include the fixed manufacturing cost of 240,000. Because that's what fixed means. It's going to remain the same, remain constant, even though our level of production changes. But our variable cost of goods manufactured will still be $30 per unit. So 240,000 in fixed cost plus, I can put this on the screen here. So our new cost of goods manufactured will be 240,000 in fixed costs plus we're going to make 30,000 units at $30 in variable cost per unit. So our total goes from 840,000 up to, oh, sorry, don't know how to use my calculator again. $1,140,000. What I'm saying, $140,000. Okay. So $1,140,000 would be our new cost of goods manufactured. That includes the same fixed cost that we had when we were only producing 20,000, but an additional $30,000. Sorry, $300,000, $30 per unit for the extra 10,000 units in variable cost. Does that part make sense?
So the numbers, the 240 plus 30,000 times 30,
Mhm.
that's all replacing the current cost of goods manufactured?
Yes.
Okay.
Yes. So if we made 30,000, so what we're doing now is if we made 30,000 units, if we made an extra 10,000 units, what would change? So it doesn't tell, it tells us that our sales level stays the same. So our revenues would stay the same, but our cost of goods manufactured would go up. The fixed cost would remain the same, $240,000, but the variable cost would increase by $300,000 because each of those extra 10,000 units costs an extra $30 in cost of goods manufactured.
Okay. Yeah, I was still just thinking that we were adding to it instead of replacing the whole thing. So.
Well, either way, you can think of it either way. So you can take the 840,000 and then just add 10,000 more units at $30 each. Mathematically, that's more efficient, but we're really doing the same thing.
Okay.
And so then we need to subtract from that our ending inventory. Well, if we now are producing 30,000 units, but only selling 15,000, okay, we're going to have 15,000 units still in ending inventory, right? Well, our total cost to produce those units was $1,140,000. That was for 30,000 units. So I need to find our cost per unit. Which would be $38 per unit. And we're going to have 15,000 units. Whoops. We're going to have 15,000 units in ending inventory. And I might as well put the negative with that to remind us to subtract. Okay. So our ending inventory, rather than just going up by the $300,000 in extra variable cost, we're also going to be shifting some of the fixed costs to those new ending inventory units. Makes sense so far? I took our total cost of goods manufactured divided by the new units, 30,000, and we have 15,000 of those left. We get $38 per unit for 15,000 units. Our ending inventory would be $570,000. And now we just need to recalculate those next numbers. So the total cost of goods sold sometimes I'm amazed at the things I actually type into my calculator. The total cost of goods sold would be $570,000. So what did we just do? Rather than using 630,000, we've shifted another $60,000 worth of fixed costs onto the balance sheet. We're calling them an asset. By producing 10,000 units that we didn't believe that we would actually be able to sell, we have increased our profit margin. Our gross profit goes from $495 up to $555. Selling and administrative are going to stay the same because we're still selling the same number of units that we were selling before. And I know those aren't lining up exactly where I would like them to, but and so that extra 60,000 that we shifted, the extra 60,000 that we shifted from cost of goods sold into the ending inventory goes straight to the bottom line and increases our operating income by $60,000. Do those calculations make sense so far? So if we produce the additional 10,000 units, under absorption costing, it will allow us to shift 60,000 more of the fixed costs to our income statement, to the balance sheet as inventory, and increase our operating income by 60,000 units. The change in operating units, the change in operating income from producing those additional units is $60,000. Under variable costing, 0. Hopefully we're good with that. And so this highlights exactly what we were saying in class, that by using absorption costing, we're really rewarding that concept of producing for inventory, not producing because you have a sale. So do we really think it's a good idea to produce 10,000 extra units when we don't think we can sell them, just to allow us to hide inefficiency or shift that extra some of that fixed overhead to the balance sheet and claim it as an asset? I would say no. And so with our question number 4, what would be your recommendation? I would say it's either going to be A or C. I haven't even read the rest of it yet, because it makes no sense to produce an extra 10,000 units when you don't expect to sell them. So let's read what A and C say. The increase in operating income under absorption costing is due to fixed manufacturing costs being held in inventory. The additional inventory will lead to higher handling, storage, financing, and obsolescence costs. Yes, I agree with all of that. And letter C, do not produce the extra 10,000 units. Operating income does not change under absorption costing. Well, we just saw that it does change. So the answer would definitely be A. Okay, so we're going to end the chapter 21 problem there. Pause for a moment. Okay, so having finished up the chapter 21 problem, I have now pulled up the practice set of exercises to prepare for exam 2. I need to point out that there are 12 exercises here across the 3 chapters that are on the exam, 19, 20, and 21. And most of these exercises have the .algo at the end of the name or the number of the exercise. That means that these are algorithmically generated. What that means is the problems are exactly the same for everybody who works on this, but some of the values, some of the numbers in the problem are going to be different. So what I'm doing here, the process that I follow will work for what you have, but the exact numbers are not going to match up. So actually that's probably not a bad thing because it allows you to see how to do it and then try it on your own. So the request was that we start with exercise number 1 in this set. We're not going to have time to go through all of them, but we'll go through a few of these based on what people who are here are asking to cover. So this is a company that is going to allocate their support departments using the direct method. So what that means is the support departments are allocated directly to the production departments. They are not allocated to other support departments at all. Let's see. So the two support departments are machine maintenance and janitorial, and the 2 production departments are cutting and pruning. Maintenance and janitorial costs are allocated based on machine hours used and number of trees in each department, respectively. What that means is that maintenance allocates based on machine hours and janitorial is based on number of trees. The company estimates that the cutting and pruning areas typically have about 21 and 49 trees, respectively, in them at one time. So 21 plus 49, that's a total of 70 trees. And hang on one second. I'm just reading what we're supposed to be doing here. Using the direct method of support department cost allocation, determine the total cost of each production department after allocating all support costs to the production department. Okay, so all we're being asked here for the total. So I'm going to add a couple of rows in here to our table. So maintenance and janitorial, and then the direct costs. Okay. So maintenance is going to be allocated based on machine hours. So I'm just going to put a note here to remind myself, machine hours, and it tells us right here, the company also estimates the cutting process requires about 9 times as many machine hours as the pruning process. So we know that cutting is going to get a weight or a factor of 9. And pruning is going to get a factor of 1. So of a total of 10 hours, 10 machine hours or units of 10 machine hours, 9 of them, 9/10 of that cost is going to go to the maintenance department, or sorry, is going to go to the cutting department from maintenance. So the total cost for maintenance is $9,000. That up a little bit. The total cost of maintenance is $9,000. We are told right here in this table. And 9/10 of that cost is incurred by the cutting department. So 9/10, 0.9 or 90% of the total cost of the cutting department of the maintenance department is going to be allocated to the cutting department. And the rest of it, the other 900, will go to pruning, which takes only 1/10 of the total time that the maintenance department spends on those 2 production departments. Does that make sense?
Yeah.
Okay, so it's probably true that the maintenance department does some work in the janitorial department. I certainly hope it's true that the janitorial department is doing some work in the maintenance department, keeping things clean, keeping things maintained. But in the direct method, we don't take that into account. We do not allocate any support departments to any other support departments. So as we look at janitorial, that's going to be based on the number of trees. And the cutting department has 21 of the 70 trees. And the pruning department has 49 of the 70 trees. So 21 and 49, total of 70 trees. 21 of them are in the cutting department and 49 are in the pruning department. So the total cost for janitorial is $4,000. And we're going to allocate 21/70 of that, or $1,200 to the cutting department based on the 21 of 70 trees. And for the pruning department, they have 49 of the 70. And so we're going to allocate 49/70 or 7/10, 70% of the total cost of janitorial, $4,000. We're going to allocate that, to the pruning department. And so what you'll notice is on each of those lines, the maintenance department, we've allocated $9,000. We allocated all of the cost out to those two departments. And then for janitorial, we allocated all $4,000 out to the two production departments. The last step is to add to that the direct costs of each of those departments. So $52,000 is the direct cost for cutting and $10,000 for pruning. And then we just need to add those together to get the total cost. The direct costs plus the allocation from maintenance and from janitorial. And if you wanted to confirm, if you wanted to check yourself, you could add up all four of these costs. What we should find, what you must find, is that we have now successfully moved all of the costs out of the two support departments and into the cutting and pruning, the production departments, and that our total costs are still completely accounted for, but they've all been assigned to production departments.
I entered those and checked my work, but it says it was not correct.
Yeah, what did I do? Pruning 21 and oh, well, because you need to use the numbers that are on your exercise, remember? So your numbers are going to be different. I don't know exactly which numbers because I can't see your screen, but your numbers are going to be different. Let me pause for a moment. And so we are now looking at exercise 9 in that practice set for exam 2. Again, these numbers are generated algorithmically, so your numbers in your exercise may not match exactly with mine, but the process that we follow will be the same. So you'll want to follow along, but the process we're following, but use the numbers that appear in your exercise. So for a recent year, McDonald's, and that MCD is its trading symbol. So if you were to look on a stock ticker, you'd be looking for MCD to find McDonald's share price. So McDonald's company-owned restaurants had the following sales and expenses in millions. Just as a reminder, we've talked about that before. Some organizations like McDonald's have company-owned restaurants, and they also have restaurants that are operated as franchises by independent owners. So we have sales. These are all in millions. We're just going to ignore that label, or, we have the label already included here for us, so we don't have to put in all those zeros. That's helpful. We have our revenues. We have food and packaging, payroll, occupancy, and general and administrative expenses. And so there's our total expenses, and then the bottom line is our operating income. We are asked to assume that the variable costs, let me get my annotate up here. I'm going to make a note of these things. So the variable costs, I'm just going to label with a V. So the variable costs are food and packaging. A little bit there. So food and packaging is a variable cost. Payroll. And then selling and administrative, 40% of that is variable. So we're asked to find McDonald's contribution margin. So let's review what contribution margin is. If we start with our sales or revenues and we subtract our variable costs, that is our contribution margin. And then we're also going to be asked contribution margin ratio. So I'll remind you of the formula for that. Contribution margin ratio is the contribution margin in dollars divided by the sales in dollars. So it's what contribution margin is, how many dollars are left of after covering our variable costs to apply toward our fixed costs and hopefully generate a profit. And contribution margin is what percent of each sales dollar is left after covering the variable costs. So in order to find their contribution margin, we start with our sales, which are 19,300. We know those are in millions. We're just kind of keeping that millions label in the back of our mind. And we're going to subtract from that all of our costs that have been identified as variable costs. So we start with food and packaging, and then payroll is also variable. And then 40% of the selling, general, and administrative expenses are also variable. Remember, as you're doing this on your own, make sure that you are using the numbers that are given in your exercise, not the ones that you see on my screen. Okay, so everybody okay with finding the contribution margin in dollars? All right, so then we're going to take that contribution margin in dollars and divide by the sales in dollars. Whoops, 19,300. Divide by the sales in dollars to find the contribution margin ratio or percent. And it doesn't tell us to round. I got a whole number anyway. So 41% is what I got. Again, your numbers may be different based on what's given in your exercise. And then the final question is, how much would operating income increase if same-store sales increased by 1.2 million for the coming year with no change in the contribution margin ratio or fixed costs? Round your answer to the closest million. So how much would they go up? Well, our sales, if our sales went up by 1,200,000, but our fixed cost remained the same, our contribution margin ratio is 41% in my numbers, in my exercise. So 41% of those additional sales would be the additional contribution margin. So if our sales go up by 1.2 billion, If our sales, let me just ignore the label for a moment. If our sales went up by $1,200 and we get to keep 41% of that, our contribution margin ratio is 41%. If we get to keep 41% of that, our fixed cost didn't change, then our bottom line would go up by $492 million. Again, the approach, the process we follow is the same, but your numbers may be a little bit different than what you're seeing on my screen. Okay, any questions about that one?